Okay, good morning. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It's 10 a.m. Pacific on Friday, July 11th. And here we are sitting. Let's check out the markets. Equities have been teasing with all-time highs this week, reaching new levels. But today, a bit of a sell-off, maybe a bit of exhaustion, bit of a standoff between buyers and sellers as everyone evaluates whether this bull market has legs. So let's just jump into the bloodless verdict of the market. And what we see is on a month-to-date basis, the S&P 500 is up about 1%, putting it near those all-time highs. We're above previous all-time highs, but not at the current all-time highs. That's the way it is when you're in those lofty peaks, right? Every step forward is a new high. So up 1% on the month from the S&P, but on the week down about 25 basis points. So, giving a little bit back. Looking at the Russell 1000 growth, looking at growth stocks up about 90 basis points on the month and 1 basis point on the week. And the Russell 1000 value is actually up about 1% on the month, but down about 65 basis points on the week. If we kind of dig into the sectors and see what the brightest part of the market is on a week-to-date basis, it's actually the energy sector up 2.5%, up over 5% on the month. So pretty interesting there. Materials also up about 4% month to date. Technology only up about 1.4% month to date, down 11 basis points on the week. And we'll kind of round it out with the defensive consumer staples is the worst performer on a week to date basis, down 2%, down 0.5% on the month. So kind of a bit of a mixed bag, but equities have produced returns for investors this month. And, it was a short week last week with the 4th of July holiday. And so, investors have been rewarded for staying patient through all the volatility of this year. And we're kind of sitting in a positive place. Now, as we turn the page to fixed income land, things are a little less rosy. Rates have sold off this week. The 30-year Treasury sold off about 10 basis points, currently trading about 4.95%. Looking at the 10-year Treasury, currently trading about 4.42% yield and up about 7 bips on the week. We've seen the curve steepen slightly since last week, steepened out to about 52 basis points, but started the month at 50, so we'll say that's just a pretty incremental steepener. So with that rate move, we've seen a little bit of a give back in fixed income returns on a mark-to-market basis, with the U.S. aggregate down about 36 basis points on the week and 80 basis points on the month, but still chugging along, earning its coupon year to date up over 3%. If we kind of dig into the sectors, we see that the emerging market bonds and bank loans are the best performers on a week to date and month to date basis. Bank loans are actually up 24 basis points this week, and on a month to date basis, they're up 40. Emerging market bonds are only down about 14 basis points month to date. The weakest performer this week, no pun intended, is the corporate bond sector, interestingly, down 73 basis points. So that's that kind of rounds out the fixed income returns. I wouldn't say there's much to say there. We had that rate rally in June and, things are kind of trending back up, but rates have really been range bound. So I think it's kind of a earn your carry market right now until something changes in the broader economy, which we'll dig into after we don't forget the commodity land. I think let's kind of dig in there. I mean, commodities are up 2% on the month at the broad index level. If you look at the Bloomberg Commodity Index, on a week to date basis, they're up 70 bips. Industrial metals, there was some tariff news. Copper got hit with a 50% tariff in the United States. So, U.S. copper prices surged about 10% on the week, currently up about 9%. But Interestingly, if you look at the London Metal Exchange, you didn't have that same price appreciation. You had actually a depreciation in the price of copper. So a bit of a mismatch there, depending on where you're delivering copper because of that tariff on copper. And it's very complicated when you get into the weeds, on like how that applies. Does it apply to raw copper ore? Does it apply to finished copper? I mean, it's a complicated beast, and there's a lot of details in there. And that's why you didn't see the price surge more than that 9%. Gold edging out a little bit of a return, currently trading about $3,369 an ounce. And, gold up about 80 basis points on the week, 2% on the month. I would be remiss not to mention Bitcoin. Bitcoin is at all-time highs, trading at over $117,000 per Bitcoin. So for all those crypto maniacs, you're, you're being proven right. The volatility, though, is not for the faint of heart. Anything that could go up 7% in a week can definitely go down 10% next week. So we'll see what happens, but that kind of rounds out where the market's at. And what do you have to say, Ryan?
Yeah, it's pretty remarkable just how the equity markets continue to ignore just the headlines. The president was very busy this week writing letters to other countries. I think he wrote letters to 23 different countries informing them that their tariff rates would increase by the beginning of August. But market seems to just be thinking that these are just negotiating tactics, and that the end result, your effective tariff rate, will probably be lower than what has been announced. And it's just intriguing to see that cyclicals are continue to outperform defensives. That's a strong signal on the growth front. And as far as the rates markets go, we got the passage of the one big beautiful bill, passed into law last week, and that
You mean the one big budget buster?
the one, yeah, exactly. Exactly. That just puts, the fiscal trajectory on a bit of a weaker path, to put it lightly. And I think, the rates markets is really just digesting what's in that bill, and you're seeing just higher term premium being baked into the long end, and that led to some of the steepening. And you did see the economic data over the last 2 weeks. Kind of surprised to the upside. Definitely not as terrible as many were expecting, which I think is a good segue into a recap of the eco data. Since it was a holiday last week, I just highlight that last week we did get the June payrolls report. That did come. The headline was better than expected. The establishment survey showed that the economy added 147,000 jobs. That was pretty significantly above what was expected, 106,000 consensus. And the household survey with that includes the unemployment rate. It showed that unemployment rate dropped a tenth of a percent to 4.1%, and the consensus was expecting for the unemployment rate to rise to 4.3. So, rate markets responded accordingly. You saw the front end sell off as some Fed cuts got taken out of the market. You saw a little bit of a risk rally on that Thursday. But, when you look under the hood, some of the details, it takes some of the shine off the headline numbers. For one, the private payrolls, you only saw an addition of 74,000, which was below expectations, which was like 100K. So you're seeing nearly half of the jobs for the month of June came from the government sector, specifically state and local education, which signals that there might be some seasonal adjustment issues. And a lot of the economists that focus deeply on these seasonal adjustments think that you might see a give back in the coming months on this segment. So take a bit of a grain of salt with that headline number. And the unemployment rate dropped, but it dropped for bad reasons, where people actually left the labor force. So that's not a good sign for consumption going forward. And then finally, just the aggregate payroll income growth. So this is just the amount of income you're getting from the amount of jobs created times the hours worked per week times their average hourly earnings, that decelerated to kind of a cycle low on a 3-month annualized basis, which can be noisy, but it's definitely something to watch, and could be an impact to consumption going forward if we don't see a bit of a rebound there. But focusing on this week, very light week on the economic data front. Saw essentially, tier 2, tier 3 economic data come through. Tuesday, we had the NFIB small business optimism report for June. Showed a slight deterioration in small business sentiment. If you look at the details, small businesses reported a softening in outlook on sales and the economic outlook, and job creation plans remain somewhat weak. Also on Tuesday, you had the New York Fed's consumer inflation expectations, which we're all paying particularly close attention to these inflation expectations, just trying to understand if these tariff-induced inflation pressures, when they do come through, whether they're going to be more persistent. And what this report showed is that short-term 1-year median inflation expectations dropped to 3%, down from 3.2 the previous month, which was a 5-month low. And this is more in line with what we're seeing in the break-even inflation markets. 5-year inflation that remained static at 2.6%. So, nothing really to glean from this. Just I'd say it looks a little bit better than some of the other survey data, focused on inflation expectations. Then on Wednesday, we had the FOMC minutes from the June meeting. And, that basically showed that, the committee's in this wait and see mode. They're concerned that, inflation will, gravitate higher over the coming months. So they want to stay on hold, see how the inflation data evolves over, the coming quarters, and just kind of standing pat. Slightly worried about the downside risks of the labor market, but they're not seeing it falling off a cliff, so they think that they could stand pat. And on Thursday, we had the initial jobless claims data. That showed that initial jobless claims declined to 227K, slightly below the consensus. No real signs of significant deterioration in the labor market. You did see continuing claims that did move up towards cycle highs, just below 2 million. And what this is showing is, as we laid out in the past, is that it's just taking longer for employees that have been laid off to find jobs. So some slight softening in the labor market on the margin, but definitely not falling off a cliff. And that rounds it out for the eco data for the week.
Yeah, pretty light week, but I think that was a good to review that payroll report that dropped. And I'm kind of aligned with you. While it was a positive report, it is like kind of semi disconcerting that the labor force is shrinking. And, as more individuals are kind of, let's say, taken out of the U.S. labor force, that's definitely going to be a headwind for growth. So something to keep an eye on there. And the One Big Beautiful Bill Act did kind of put aside a massive budget for immigration enforcement. So you could see the labor force decreasing in size, which will be a potential headwind for the labor market going forward. So that's just one thing to keep on the radar screens. Kind of Fed watch, looking at the interest rate kind of speculators. If you look at the interest rate futures, there's definitely more expectation of a cut coming in September than there was previously. Currently, a 64% chance of a cut in September. So that's kind of interesting. And we also have the kind of shadow Fed talk heating up. President Trump, it looks like he wants an Apprentice-style battle, but the battle of the Kens, to see who's going to be the next Fed president. I mean, right now there's definitely a lead horse, but it's I think it's too early to call. What do you say, Mr. Kimmel?
Yeah, I agree. I think it's too early to call. Definitely seems like the president wants lower rates, so he's probably interviewing for who can ease policy the fastest when put in the right position.
Yeah, that's definitely job requirement, I guess, on your resume. Which way do you want rates to go, up or down? And based on that answer, your job prospects get brighter or more pessimistic. So yeah, I mean that's kind of the Fed watch stuff. Well, there is a Fed meeting on July 30th, but it's probably going to be a nothing burger meeting. But we'll naturally keep all our listeners updated. And next week is a more interesting data week. So why don't you run through that, Mr. Kimmel?
Sure. So big week on the inflation front. We get CPI on Tuesday. Markets will be paying particularly close attention to the June CPI report. Markets expecting a bit of an acceleration in the month-over-month prints and the year-over-year prints for that matter. Expecting 30 basis points on headline and core. I'm going to be paying particularly close attention to any hint at, the tariff impacts, how that's feeding through into core goods. But I'm also going to be looking at some of the more persistent categories like shelter inflation, owner equivalent rent, super core, just to kind of see what's going on with these more sticky components of CPI. Then on Wednesday, we get the PPI. Also important to see how tariffs are feeding through into that component. And it also is important for, modeling out the PCE number. And then markets will pay close attention to retail sales on Thursday, kind of get a gauge on the health of the consumer. The control group, which is the segment used to model the goods component of personal consumption and GDP. Market's expecting a 30 basis point increase there. Then we got initial jobless claims on Thursday, and then University of Michigan on Friday. So pretty interesting week. Could have some impacts on maybe Fed pricing, not for July, but for September, if this inflation data comes in hotter than expected. Not saying it will. I think a lot of unknowns are really going to be embedded into this number. Just trying to understand like how much of a tariff impact will feed through.
Yeah, definitely some interesting stuff to look out for next week. So stay tuned, and we'll give you a recap on next week's episode of DL Minutes. And that kind of wraps it up for the week.
Yes, thanks to all our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Thanks for tuning in, and I hope everyone has a great weekend.
Thanks. Take care, everyone.